So, you must be here because you want to know more about the Marigot series. If not, you probably missed part 1. Check it out in the link below. On this episode, we take a look at the requirements to qualify for a mortgage. But before you walk into that bank, there are some things that you need to know beforehand. Yes, you've decided that you're going to take that mortgage loan and you expect the bank to give you all the information that you need. So let's prepare for that meeting right here, right now on Financial Fridays. Do you remember my first video on the debt to income ratio? How many of us know our debt to income ratio? I know mine, and it needs some work. It's important to know what your ratio is because different banks have varied risk appetites, and once you know their targets, it's easier for you to start putting in the work right now. The average qualifying rate is between 40 to 60%. Then when you get to the bank, you'll want to know if a deposit is required, and if so, what is the down payment percentage. Then I'm sure you'll want to know what is the loan repayment period. Some institutions are more lenient than others. Loans can run for as low as 15 years to as high as 35 years. What about property insurance? How is that handled? Some institutions take a forced savings to pay it on your behalf. Others allow you the discretion to do it on your own. Remember that life insurance we talked about last time? Does the bank offer creditor life insurance or small amounts of life insurance? It's important to know what is best for you. Owning your own policy or going with creditor life. That's where cost versus coverage comes in. Creditor life decreases with the mortgage balance. It provides coverage only for the mortgage amount. With your own policy, the value stays the same as the loan is drawn down. So your family gets the extra once the mortgage is paid off after your death. Now, if you realize it's too late, it may be difficult to get coverage due to age and health. So when deciding on a mortgage and deciding the life insurance policy, look past the cost and at what you want to achieve, because sometimes just leaving an asset behind, it's not enough. Insurance is the solution to the cash flow challenge for your family following death. With no cash, maintenance can't be done to the house, which may result in its sale anyway. So while some may have so much pride in leaving a house behind, if you don't equip your family with the tools to preserve your legacy, you may just be working in reverse. Then the bank might ask, what is our risk profile like? A credit check is always done to see if we have debt or savings in other institutions. But did you know they check our payment history? So those missed credit card payments, they tell them a story. What about the equity to collateral rate? Some banks may give a higher percentage. For example, if your land is valued at 50K, you may get up to 40K secured using the land value. Remember in part 1 when I mentioned rental income? In addition to doing your market research, find out the procedures for home ownership versus rental apartments. Many times, the bank would consider the expected rental income to determine your ability to pay. This brings us to the terms and conditions of these institutions. Credit unions require a number of shares, banks require a security savings. Some even offer free insurance up to a certain amount. Different institutions may tailor the requirements by clients, even offering various rates for different circumstances. And what if you decide to pay off that mortgage in full? Yeah, it happens. Inquire about the penalty rates to pay off that loan in full. Some banks charge at least 6 months interest plus the payout value. Whew. That was a mouthful. But wait, there's more. The standard requirements for mortgage application include proof of address and ID, 2 references, confirmation of assets and debt, proof of required down payment, credit report, job letter and recent payslip. If self-employed, your last 2-year financial statements, a tax clearance, and 12 months bank statement. The certificate of title and approved plan from the planning division. a detailed builder's estimate and contract, a contractor's all-risk insurance, and a quantity surveyor report. It may sound like a lot, but all financial institutions are usually willing to work in the best interests of their clients. Everyone's experience will be different, but if properly applied, these tips will surely help you in your shop around for the best mortgage. Now, just because you qualify for the amount that you ask for does not mean that you have to take everything. Leave some room in your budget for your other financial goals. If you can't afford or don't need a 3-bedroom house, why build it? Too many times we stretch ourselves too thin trying to satisfy our wants. It all depends on our long-term goals. For those of us who feel we may never qualify, it's time to change that mindset. We can start slow. Whether it takes us 6 months to put up 4 pillars, slow progress is still progress. Don't get caught up in thinking that we have to finish everything in one go. Now take a look at some attractive mortgage interest rates in the local market. I hope you enjoyed Financial Fridays, the mortgage series. See you next time. Bye.